This is Linda Hitt. We're going to talk about adjusting entries and how they're recorded and when. And we will look at a problem, a accounting cycle problem, and actually do those entries. Adjustments have to be done before you prepare your financial report. So if you do monthly statements, you need to prepare adjusting entries monthly. You could do monthly statements quarterly, semi-annually, or annually. But definitely the adjustments have to be done or your statements will not be accurate. There are many types of adjusting entries. We can identify 4 specific categories. 2, dealing with accruals. The situation is there's been no cash flow earlier, and yet we've either received a service, which would be an expense, or we have performed a service, which would be a revenue. So accruals, an example of an accrued expense would be employees that work for you at the end of the period who maybe the pay period hasn't actually ended until next year or next period. And we need to record their services as a cost of this period. The accrued revenue might be the case of interest earned on a certificate of deposit with the bank, some type of investment that we have, and the certificate isn't going to mature till the end of the period, so we won't be collecting revenue. So once again, we make an effort to include revenues and expenses to make sure our income statement is accurate. On the deferral side of things, we often kind of put off recording revenue until it's earned. We put off recording expenses until we've actually had assets used up. So you may have paid for something, we may have collected money from customers before we've actually performed the service, which would be the deferred revenue, and we may have bought something that is an asset like a car, and we're going to depreciate or expense it as we use it up over time. So those 4 categories, we can pretty much fit all our different examples of adjusting entries into those categories. Deferred revenue we have if we have like season ticket sales, magazine subscriptions, deposits from customers, anytime you collect money in advance from customers before you've done the work. And your expenses, tons and tons of assets are owned by the company. Most of them get used up in terms of operating. Adjusting entries definitely impact the statements. 2 deal with revenues, 2 deal with expenses. So if we don't do any of the adjusting entries, or if we leave anything off, the income statement is definitely wrong. The balance sheet also is impacted because, as you can remember, 2 deal with asset changes and 2 deal with liability changes. So it's important that we record everything. Cash flow statement is an exception. Your adjusting entries usually don't include cash because cash entries are done as daily entries and have already been recorded. The only exception is sometimes companies will do a bank reconciliation at the end of the month because they wait till the end of the period, and if they include those entries as part of adjustments, they would have cash increases and decreases. So now we are ready to take a look at our problem. So let's go to the problem that we started the other day, and I've kept the entries that we have that we need to help us to figure out the adjustments. So we're going to look at the first one, which asks us to deal with expired insurance. If you remember, we did an entry up here for paying for an insurance policy for a full year in advance. So we did use an asset approach and we set up prepaid insurance. Now we're being asked to adjust for that. Notice that we are doing adjusting entries once a month. So we've made entries for the month of January, the daily entries, and now we're going to adjust at the end of January so that we can do a January income statement and an end of January balance sheet. So if we assume that the insurance policy actually started January 1st and we just paid for it on January 5th, then we're looking at a full month. If we think about the categories of adjusting entries, the assets used up, accrued expense and revenue, earning the unearned, we need to decide first what type of adjusting entry do we need. Prepaid insurance is definitely an asset, and the assets being used up, so the first category would make the most sense. Assets used up assets go down, we need to recognize an expense. Recognizing an expense is always true. Next, let's see if we can do the calculation for it. So we have, we could do this in our heads, but we have $1,200 for the year, and we're going to divide by 12 months, since we're looking at just 1 month, or times 1/12, and it's $100. So we're going to enter $100, whoops, wrong place, over here. And that's why adjusting entries often are harder, because you have to deal with titles as well as calculations. And we want an expense title, so how about an insurance expense being recorded first? We debit our expenses, and then prepaid insurance, the asset is going down. The impact of an asset used up on the statements. For the balance sheet, we see the assets going down. The income statement, because we have an expense, we have less profit. Expenses are closed into retained earnings, which is on stockholders' equity. So we also see stockholders' equity going down. So you can see the balance sheet still balances, and we have an impact on the income, and of course no impact on cash. Next, we're going to look at accrued salaries. If we look at our choices, an accrued salary usually represents folks that have worked for us that we simply haven't paid yet. Maybe the pay period hasn't even ended for this month. So accrued expense would be the appropriate choice. We need an expense, and we're promising to pay these people, so we need a payable. And the amount's given, so that's good. We don't have to do that. So we'll put salaries expense, if I can type it, and we will do salaries payable. And the $1,000 will be picked up. The impact of an accrued expense on your statements is to have a liability going up. Profits are going to go down because of the expense. Retained earnings goes down when you close the books, and that's going to cause stockholders' equity to also go down. No cash. Next, we're going to adjust for services that were earned for cash collected in advance. So the entry that we did up here was a full year of cash collected in advance on January 15th. So first of all, what type of adjusting entry will we need? If we go back to our choices, we're looking at a situation where surely we've earned some of that money that we've collected. If you look at your choices, earning the unearned is the appropriate choice. Basically, we are now looking to move some of this out of the liability account, unearned revenue, to retained earnings to recognize revenue. So we have that, and then let's go ahead and do the calculation for it. We have a collection of $2,000. Now if we did it for a month, we divide by 12 because it's a 12-month contract, which would be about $167, but we've actually only done a half a month. So let's divide that in two for a half a month and round to the nearest dollar. So it looks like $83 would be appropriate. So we'll put in 83, and we'll debit unearned revenue, and we'll credit revenue. Okay, the impact on your statements, you're going to be actually lowering your liabilities. Your revenue is good news, so we'll see the net income going up. Retained earnings will go up with the closing of the books, and therefore stockholders' equity would go up. Okay, next we're going to adjust for services performed and not billed. So maybe we've done the work, but maybe we don't have all the information yet to send out the bill. We're missing some data to do the invoice. But we want to be sure that we do include it in this period because it's earned this period. So if you look at your choices, since we don't have any cash involved earlier, this would be a good example of an accrued revenue. We plan to receive the money from the customer, and we want to recognize that we actually have a revenue. So some type of receivable and then some type of revenue. So let's just go ahead and use accounts receivable. And $300 is given. and then we'll do, I think we had service revenue as our title. Sorry, one of those bad typing days, so like a bad hair day. Impact on your statements. So you're going to see your assets going up, your profit's going to go up because of the revenue, close the books to retain earnings, and we see stockholders' equity increasing. So it's sort of a win-win. Oops, I put this in the wrong spot. I want net income to go up, assets and stockholders' equity. Next, we're going to adjust for supplies used. If you look previously, we purchased supplies for $500 and we made an entry for those. Now we're being told there's only 100 left. So we're looking at supplies being used up. If we look at our choices, what type of adjusting entry is this? Supplies is an asset. Assets should be going down if you're using it up. Assets used up always become an expense. So lots of assets owned by the business, a lot of expenses need to be recorded. So we can make up an appropriate title, supplies expense, and supplies. And then math-wise, which this shouldn't really be too hard, we started with $500 of supplies. We now have only 100 left. So we're comparing asset value at the beginning to asset value at the end, and we can see we've used up 400. So we're going to put $400 in, and we're going to put the expense first. So we have supplies expense, and then we have supplies as the credit. Okay, the impact of assets used up, we've seen that already. Our assets are going to go down. Net income is going to go down because of the expense, and retained earnings is going to go down after closing. Okay, the last entry we're going to look at is the interest accrued on the notes payable. So if we think about what type of adjusting entry we have, it's a cost of borrowing that we need to recognize. We haven't paid for any of the interest yet. So it looks like another example of an accrued expense. The good news, you don't have to worry about calculations. So let's see, accrued expense would be an expense and a payable. So how about interest expense and interest payable with $10. And accrued expense causes a liability to go up, profits to go down because of the expense, and retained earnings also to go down. So this concludes the adjusting entry piece. In the next video clip, we will get into posting to the ledger to get a balance per account and preparing the trial balance, eventually working to preparing the statements.